The Fed really done raising rates? That is the question Wall Street is pondering after we got a quarter-point hike this week. Another strong jobs report this morning with revisions. Earlier today, St. Louis Fed President James Bullard said he is ready to be data dependent with an open mind on whether to pause or hike at the June meeting. Joining us now is Neil Dutta from Renaissance Macro Research. Neil, you don't think there's a recession in 2023, but you still expect that there might be more hikes this year. How do you feel after this jobs report and the revisions we got to previous months? Do you still feel that way?
Yeah, sure. I mean, ultimately, if you look at the 3-month trend in employment, John, it's running over 200,000. And so, that's more than enough to keep pushing the unemployment rate down over time. Certainly, it's wholly inconsistent with the idea that the unemployment rate is going to rise a full percentage point between now and the end of the year. That's actually what's baked into the median Fed forecast. So, what I see in the economy suggests, more room for improvement than not. I mean, no one's really talking about the fact that new home sales are at a one-year high. No one's talking about the fact that inventories have taken so much out of growth now. They're basically at a point where they're probably going to be adding to GDP. So no one's talking about. Sorry, go ahead.
So what does that mean for stocks once investors figure out, if you're right, that there aren't going to be rate cuts coming because there won't be a recession and that things are actually kind of okay?
Well, it's sort of, damned if you do, damned if you don't. I mean, I think there's probably some room for upside in equities, but I think ultimately it would be a trade you'd want to rent, not own, because, as you mentioned, I think the Fed will have to step back into this right now. I mean, there's no way the Fed can let go of its tightening bias with the unemployment rate as low as it is. And if I'm right about the economic outlook, they could, at best, maybe skip meetings over the summer. But I do think by September we might be talking about hikes again. And I think the stock market would respond to that. It's somewhat ambiguous, obviously, because that would also imply that the consensus is somewhat underestimating earnings.
When I hear you lay out that thesis, which is very contrarian to what we're seeing in the market right now, how real is the possibility of stagflation here?
I don't think that it's certainly possible. Obviously, inflation is a lot higher than any of us have really ever seen, and it's been that way for quite some time. But I think we have the deflation. We don't have the stag right now. Mm-hmm. I don't believe. I mean, as I mentioned, the risk was really a lot higher, in my view, last year when we were talking about the housing market going bust. Inventories were shedding. We had global growth concerns, food and energy supply shocks. Fiscal squeeze. A lot of those things have actually gone the other way. And so, at the margin, that represents upside. And it's not really about the economy having to go gangbusters. It's really about what is the consensus pricing in and what you think the likely outcome is going to be. And remember, the consensus and the Fed, frankly, basically see no growth over the next several quarters. I'll take the other side of that. I think there's upside risk.
Okay. Neil Dutta, thank you.